Hello and welcome to the stock specific class here for Thursday, December the 29th. This is the last class of the year. We'll hit 2023 next week, and I'm sure we'll have a lot to talk about in that first. Well, I don't know. I talked last week or earlier this week about the possibility of seeing a bigger market drop into the new year somewhere in that first couple weeks. But I wouldn't be shocked if we get a little bit of a rally a day or two into the first part of the new year, just to throw some people off. And I'll show you how that could play out when we look at the charts here in a second. Yeah, it wouldn't shock me too much. But before I get going, if you have any questions during the week, any questions I don't get to here in the live class, or any questions if you're reviewing the recording of this class and you have a question, make sure you send that to jerry@traderspro.com. I'll be happy to answer that for you. All right. Quickly go through the direction alerts. We're still seeing that kind of a mixed indicator here where we've got momentum down here in the extreme range. So we are a little bit, market is showing a little bit oversold, not extreme. We're still not to the right side of that box. Usually I'll cut this in half, and if we're on the right side of that halfway point, that tends to be a lot more overbought, oversold. And with today's rally, we could see this push into the sell area when these indicators update overnight. So we'll see how that plays out. But the weird thing is that you've got usually set momentum and breadth are going to be pretty close, but breadth is right smack in the middle. It's not showing any extreme at all, which means that there's not a lot of stocks participating in that selling. And this makes sense if you look at the difference between the Dow Industrials and the NASDAQ 100. The NASDAQ has been really dropping. The Dow has been holding up for the most part pretty well. And so, what I'd be looking for as far as market weakness do you start to see the Dow sell off in a stronger percentage way than the NASDAQ. The NASDAQ stocks, you look at a lot of them have really been beaten up, but I look at a lot of the Dow stocks, and a lot of Dow stocks look like they could have a lot of room to come down if there is more selling. And so that I would expect to see more carnage in the Dow stocks if we do end up getting this bigger sell-off into the first part of the new year. But the breadth indicator is kind of telling us that there isn't full participation in that selling, and it's just saying there's no extreme. It's not extreme overbought or oversold. It could go either way, but the current trend is down right now, and so I would assume that that's going to continue down. And it really has to do, for me, it has to do with the market sentiment, the VIX. There just hasn't been any concern for a sell-off, and yet everything that I can see is pointing to a recession next year, and the market hasn't accounted for that. If you say, well, the market's accounted for it because of the decline it's been in pretty much this whole year, that decline has been because of the rising interest rates. It hasn't factored in earnings being adjusted downward. And, obviously January is going to be an earnings month. A couple weeks into January, we'll start to see the bank stocks, usually the first ones to report earnings. And that's what the market will be looking for. Maybe that's what it's waiting for, is actually seeing those adjustments revised downward is when, maybe that's when the bigger selling will take place. But a lot of times the market already anticipates that ahead of time, usually. And I guess that's why it's been a little bit surprising to me, because the VIX is what you're looking at, what professional traders are doing. These are the people that have the years of experience. They have the software programs to be able to break down these companies, and they've got access to inside information, economic information that we don't have. And but maybe you can make the argument that maybe they know something that things are going to hold up, and you know, that would be valid if it showed up on the charts, but the charts themselves are looking very bearish. Remember, the charts themselves are being created by these professional traders as well. Through their buying and selling, it creates these chart patterns. So I would tend to, again, everything I've been analyzing, I tend to come back to and lean to the next move being down as opposed to up. But there again, you know, one thing you'll hear, anyone that's been trading in the markets for a long period of time, you know, that you'll hear them say you can't ever know exactly what the market's going to do. The reason why you hear almost everyone with experience say that is because they've been beat up. They've been beat up at times where they were sure the market was going to do something and it didn't. But on the other hand, you know, I think it is important to kind of read based on your experience what you're seeing on the charts and the trends, and you can still have expectations. The key, and I touched on this a little bit earlier in some classes, the key is to be able to pivot or adjust when the charts are telling you need to do that. So as bearish as I've been and continue to be, if suddenly the market starts moving higher and starts breaking to higher highs and higher lows, and I'm a trend trader. I'm gonna start turning more bullish because the charts are telling me I need to turn more bullish. And I think that's probably the key to all of this is just not getting too sucked into one directional bias that you ignore when the clues are changing and it's showing you a different direction. All right, so sentiment. So sentiment's still very high, and just the complacency in the market is really extreme. And when it's this extreme, now it's been extreme for a long time, so this is not suggesting that we're going to drop immediately. That expectation that I think we're going to drop soon, whether it's starting tomorrow or starting next week, comes from the chart patterns itself. But that has remained elevated, has worried me. It's really been a headwind for the market to rally when you're already dealing with a market that's extremely complacent. So that's been something that's bothered me for a while. If you've been following for a while, and it continues to do so until I see it play out in the markets. Buy sell ratios, again, not much has changed from Tuesday. They're wide, but they're not too extremely wide. We could see. It's possible we see a little bit more selling, but it's also not surprising that we're seeing a little bit of a bounce or a rally today. You know, we're getting it. We are a little bit stretched in areas, and when you get a little bit stretched, you can still get these little bounces. And like I said, when I get to the chart, I'll show you. Well, it's kind of the same area I talked about on Tuesday. Yesterday kind of threw me because I thought we'd rally a little bit through the end of the week, and then yesterday it looked like maybe we were going to just fall apart before the end of the year. And then we're right back up again today. So it's kind of whipsawing back and forth, and you know, that markets will do that. They'll keep you on your toes, but the overall pattern though still is looking like a decline's coming. There's other sentiment indicators, again, near the extreme oversold range, but up a little bit, and probably be up a little bit more today when it gets updated. But we do want to recognize it is a little bit stretched. It's a little bit in that oversold area, and so you know that we can see markets rally a little bit when you get down to those extreme levels. So that's why we pay attention to them. All right, let's get into the chart here. And on Tuesday, I talked about the expectation that, this is maybe wave A, wave B, and then you get wave C coming up here a little ways, maybe up into this 389 area on the chart on the SPY. There's a lot of resistance in there. And again, when I look, I hesitate sometimes to write down numbers because people start to look exactly at that number. Are we going to rally exactly to 389? No, I tend to look for zones or areas. You can tell that there's resistance right here. There's a little bit of support right here, but there's a little bit of support right up in here too, where it's just a little bit higher, where it had. So you see, you got more of a zone right here than an exact spot. Now, sometimes markets do rally to an exact spot in reverse, and you can see it, especially on the intraday charts. Fibonacci levels and things like that, and people use pivots and other types of mathematical formulas, and it is pretty amazing sometimes when you see the reversals right exactly at spots. But I'm telling you, none of those software programs or calculations tell you exactly what's going to happen. There are always times where it moves past these levels, and so if you're always looking for exactness or expecting exactness, the market's never going to give you that. It's never going to give you a formula that's always going to work or always be right. So I tend to not try to focus on that exactness. Look for more areas. But then we got yesterday's move where we dropped lower and closed at the lows of the day. That was a very bearish close. And I thought, man, maybe we're just going to take off and drop from here. And then today we have this bounce again. Now, all of these are taking place on lighter volume just because it's the holiday week. And we're going to see volume really get light tomorrow ahead of the New Year's weekend. So you're not getting a lot of volume confirmation with some of this stuff. So what can happen is you can get whipsaw moves like this in lighter volume trading environments. But overall, whatever the near term. So with what's happened over these last 2 days, I can't predict what's going to happen tomorrow or forecast what's going to happen tomorrow. It's a coin flip the way the market's behaving. But what you want to pay attention to is the overall movement over the last week or so. We've been moving sideways. This gets back to a phrase you hear me use over and over again, but what I'm hoping for is that anytime you see this, you hear my voice, and it reminds you of the probabilities. And that is that anytime you see a stock or the market moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. So now the key there is when it's done moving sideways, we could bounce back and forth for a few more days and then drop, and that would still work. We could rally up into this area here a little bit, and this could still look corrective, and it could still end up leading to a drop. So that, in my opinion, the chart is still behaving like it wants to go lower. And again, you can see the sideways movement is indecision. Okay. Now the sideways movement itself isn't going to tell you where it's more likely to go, but and this is a physics law or what have you, that what is it, the object in motion is more likely to stay in motion or keep going in that direction. I don't know if I said it right, but I remember something like that from my college years so long ago. But in other words, it can reverse. You can reverse a direction, but it takes a lot more energy or force to reverse a direction. And so it takes a lot stronger buying to reverse this initial downward move. And you're not seeing that. Each of these up days have been weaker volume, and they haven't been able to really take off. And so what tends to happen is that the higher probability again, because you can find situations where you move sideways and then go right back up again. But but that's a bullish sign as well if that could happen, because that tells you that the buyers were weak right here, the direction was down, and then they reverse that direction. You start to get an impulsive move up out of a sideways corrective move that's showing you buying strength when that happens. Okay, you want to be able to recognize that. Now, you probably wouldn't be able to recognize it for a few days because it would need to start looking more impulsive. You get 3 or 4 days in a row where you're moving up strongly, and that would be an indication to me that maybe that's that there are buyers that are strengthening or gaining strength at that moment. All right, so now another thing that's interesting. Let me go back. Let's go over to well, here's the Dow. You can see the Dow again has been holding up better than the rest of the market, but again, this is kind of a corrective phase. It looked like it was starting to move down. I looked at a lot of Dow stocks yesterday, individual Dow stocks. Almost all of them had bearish reversal patterns. And just because we're up today doesn't necessarily mean that that's not a valid bearish reversal candle. Sometimes, like I said, the market will fight to try to go a little bit higher. It still creates that choppy behavior there, and then it can roll over. It just might mean that it's trying to rally one more day or two. A lot of resistance into this area right here, so that'd be a target of where it might find resistance. There's a little bit of resistance back in here. So those are areas to kind of watch as well. But I thought what was interesting was the NASDAQ. Now, what do I keep telling you about the NASDAQ 100? I say it over and over, and especially compared to the Dow. I said that what's bothered me is that the Dow has been rallying, but the NASDAQ has been lagging. Now, the NASDAQ tends to be the leadership index. It tends to lead the way. If the market is really in a strong bull market condition, or it's going into a bull market condition, what will typically lead the way is the NASDAQ 100, and then the Dow will be following it. We got the opposite here. So it's made me really not trust the rally. Obviously, I understand that a lot of that money has been coming out of tech and going into more stable companies that are resistant to inflation, resistant to slowdowns and things like that. A lot of the industrial type companies and energy, obviously, and even some of the financials have held up the Dow quite a bit. Consumer staple stocks have held up the Dow quite a bit. But one thing that was interesting that happened yesterday was we closed at a new 52-week close. Now you could look at the chart here and say, well, Jerry, no, we were lower down here. Well, I'm not saying that the NASDAQ closed at a new low of the year, or didn't close at a new low of the year. It was a new closing low. Remember, on this day, we opened down here, we closed all the way up here. So here were some closing lows. And you can see we barely closed. So we did have a new 52-week low close on the NASDAQ 100. Okay. What is the NASDAQ 100? It tends to be a leadership index. Okay. So now, again, we're not going to know this for sure until maybe a week or two later from now, if this does play out. Is this showing us that, is this confirming that likely downtrend in the market, likely sell-off in the market? I don't know. But again, these are all these little clues I'm trying to teach you in these classes that you look for. What we're trying to do right now is just get an idea of how is the market acting right now. Is it acting like it wants to go up? Is it acting like it wants to go down? Is it acting like it wants to go sideways? And I want to use that to make a decision on whether or not I want to be in the market or place a trade or not place a trade. And this is a subtle indicator. You're not going to base your trade on that alone, okay? But it fits in line with, just like I said, just what I went over with you with the S&P and the Dow moving more sideways these last couple of weeks. indicating we should get another move down. By the way, the NASDAQ hasn't been moving sideways. It's been going straight down pretty much. A little bit up today. Maybe it starts moving a little bit sideways or consolidates a little bit over the next day or two. Who knows? But I thought that was significant, and partly why it's a little bit surprising the market bounced today. I thought for sure that would trigger a lot more selling today, but knowing it's a holiday week, remember, professional traders, a lot of them are on vacation right now. They don't want to deal with the market panic sell-off that they've got to go back to their computers while they're at the beach and they want to enjoy the weather. They don't want they don't want the market to take off either, where they feel like they got to go buy something. They want to enjoy their vacation. They want it to be sideways if at all possible. And so maybe that's why we're seeing a little bit of a bounce here today, and maybe we'll see a bounce or continued bounce tomorrow. Is that not wanting to have to deal with that until next week? We'll see. All right, so I thought that was significant. Obviously, the Russell 2000 also tends to be a little bit of a leadership index, but it's looking again more and more like the Dow and the S&P. This could be kind of that wave A, wave B, wave C, sideways kind of consolidation should end up leading to another move down. But I mean, you look at that candle today. If we close near the highs of the day, that would be a bullish candle. Now you could make the argument that this is a very bearish close yesterday. We didn't go lower. What makes you think a bullish close today would means we're going to go higher tomorrow, or should go higher tomorrow? You're right. It doesn't help clarify anything when you whipsaw like that. It doesn't make me trust that we're going to rally up the next day at all. It makes me feel more and more like I want to just sit on the sidelines and wait for everything to play out. The bottom line is that even if we could go up a little bit further, it's like, unless you're doing a really short-term trade, if you're day trading or doing short-term swing trades, could you buy something you think could go up or rally for a day or two or something like that? Absolutely. But this software, this class is a little bit more focused on not necessarily long-term investing, but trying to catch longer-term trades. We're not looking to really be jumping in and out of things within a few days. And so the bottom line is that I just don't see a market that's likely to rally much and has more potential to go down. That leads me to want to stay more in cash, stay on the sidelines, or maybe be prepared, not yet, but maybe be prepared to jump into some of those inverse ETFs that go up when the market goes down, the ones I've been using. By the way, I did get into a couple of those at the end of the day yesterday, but I got out of them this morning because it just reversed right back the other direction. Like I said, yesterday it looked like it was going to start dropping, so I wanted to make sure we had that hedge in the portfolio a little bit. But I got right back out of them at the open today, and I'll watch it if it's reversed back down tomorrow, or if some reason we have a really weak close where things reverse from where they are now and come way down. Maybe I'll jump back into those again. All right, bonds. Again, this looking a lot more impulsive downward. Now we have a little bit of an update today. This is starting to take a little bit of a sideways look to it. Now, that's not enough yet because you could start have 2 or 3 days where this really jumps up and looks more impulsive again. But if we do kind of have another day or two or a little bit more sideways, that would probably be signaling that bonds might continue to drop. But this is throwing us a little bit of a curve. We've got impulsive down, we have impulsive up, and then we've got impulsive down so far, and it's just not a lot of corrective behavior in there to gauge the trend direction. It also wouldn't shock me if suddenly it goes impulsive up, especially if the market starts selling off. We saw it happen through here where a lot of that rally was traders going into the safety of bonds, which you haven't seen for a while. But if some of that fear of the market selling off sometimes traders will go into the bond market, not that they're going to get a big return, but that they're at least getting something instead of just being in cash. They may go into the bond market there, and that would cause the bond market to rally a little bit. So not a real clear direction there in bonds that I could give you, but that's something we'll continue to keep an eye on. Gold, I still am bullish on gold. Now, gold has been kind of choppy a little bit, but it's kind of forming what we call a ascending triangle pattern here. If this breaks out to the upside, usually what you can do as a rule of thumb is you take the base of the triangle, so this point to this point, and project that upward. If we break out right here, there's a big move in gold that we could see, and that's why I'm positioned the way I am with an individual gold mining company, and then the GDX, the gold mining index there in the portfolio. And I'm going to continue to hold that to see if we do break out of that range, but it's looking more and more bullish the way it's behaving. So we'll see if it starts taking off again. And that's some of these you have to be kind of patient. That's why I have on the trade I'm in that I have a wide stop on it is I don't want to get bounced out of the thing. I think it's going to make a move. I don't mind the volatility and the risk of getting stopped out to have it make that next move that I think it could make. So I'm still pretty bullish on gold. And if you're looking for an area that you want to get into, I'm not saying I definitely don't want to put a huge portion of your account in anything right now, but and if the market sells off, I've said this too, if the market has a big panic sell-off day, everything goes down, and gold would go down as well, likely. But at least initially on some of those panic selling days, it'll probably recover a lot faster after that. But just be aware of that, because sometimes anytime I say something, I have to be really careful what I say in classes, because I know there's people that it's like they're tuned out. Everything else I'm saying, it's just blah 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 blah, gold, and that's all they hear, and they go hit the buy button. They use their whole account to buy whatever stock I mentioned or and I know that happens, unfortunately. And no matter how much I warn people, you can't trade that way. You're going to blow up your account. Some people have to blow up their accounts to learn. And I've learned that over the years as a coach that, it's like my kids growing up. My oldest son was always very cautious. If I told him the stove was hot, not only would he not touch the stove, but he would make sure other people wouldn't touch it. He'd warn everybody else too. My second son is the daredevil, the one that I dread getting that phone call in the middle of the night. He's the one I'll tell him not to touch the stove, and he's got to touch the stove to understand that it's truly hot, and he's going to burn his hand, but he just has to do it. He can't just take my word for it. There are those types of people out there that no matter how much you warn them, they've got to experience the pain themselves. And I've learned that over the years. As much as I hate to see people lose money, I know that if some people, they just got to blow out of an account or two before they're humbled enough to understand, money management is important, risk management is important. And that's fine. It's an expensive lesson to learn sometimes, but if they're really committed to trading and learning, they'll learn it. They'll just learn it the hard way, and hopefully you learn it the easy way, and you listen to the warnings I give you and the admonitions I give you ahead of time, and that's the whole purpose of these classes is to get you to not make the same mistakes I did, get you through that learning curve a lot quicker and a lot less painful. And you can if all you do is listen and do what I'm telling you to do. All right, that's my soapbox lecture for the day. Oil. Now, again, on Tuesday, actually going back into earlier last week, it looked like this was a bearish ABC pattern. I thought that was a bearish reversal candle. At the time, it was an bearish engulfing candle, but it managed to move up a little bit higher into the close. Maybe that's why it didn't reverse right away. You got a bearish indecision candle on Tuesday. We had a downward move yesterday, and again, this is what I taught you, is to look at these ranges. These ranges are important. On this day, we moved above that range, so it kind of it changed. It turned from a bearish day back to a bullish day. Here, you still kind of contained within the range of the day before. That was Friday because we were closed Monday. Markets were closed Monday. But yesterday we moved to the downside of that range, which was a more bearish confirmation, although we came off the lows of the day. Today we've opened lower and we're trading up here. It looks like we're going to end up being inside. Now remember, an inside day doesn't give you any confirmation one way or the other. Now, this, with the move yesterday coming off the highs there, this still could be a bearish ABC pattern with oil going lower. But remember what I said on Tuesday? I said the problem that we have to also consider is we're at a deep retracement of this move down. Typically, when you get past 50%, or particularly 61.8%, which is probably right in this area right here, the probabilities, once you get above there, the probabilities of this leading to another decline diminish. Doesn't mean it still can't happen, but it diminishes. Now, with yesterday's move, it kind of looks more like that decline could happen. But today, it's thrown it back into indecision. So what you'd want to see tomorrow, if you're bearish on oil, is do we close below that range, below this area right here? That would kind of confirm the bearish sentiment or bearish outlook. If we manage to close above yesterday's high, either today or tomorrow, that would lean us more towards a bullish. Because now, at that point, you're not only you at a deep retracement, but you'd have higher highs, higher lows. It's acting like an uptrend through here. And now the real bullish is if we get above this area right here, because this was a lower high, this was a lower low. This is where I'd be forced to turn more bullish on oil. And I have no problem doing it. It's not like I care. Well, I care as far as filling up my gas tank every week. I really hope this is leading to another move down for that selfish reason. But hey, if oil's going to go higher and I'm going to pay more in gas, at least maybe I can do some oil trades to help pay for that increase in gas and turn more bullish on some of those oil trades at that time. So that's what I'm looking for with oil. Like I said, right now, still leaning a little bit more bearish with yesterday's price action, but back into the indecision range with today, the way it's trading today. We'll see if we get a little bit more clarity next week on that when we have next week's class. The dollar starting to move a little bit lower today, and that could be a reason why oil and gold is rallying a little bit. They tend to move in the opposite direction as the dollar. But overall, a sideways move should lead to another move, continued move down. No different than really what we were seeing Tuesday there. So that would be my expectation on the dollar. And then the VIX, again, that's what I keep coming back to. Let me switch over to my other charting service. We can see the actual VIX VIX indicator. This is, again, anytime we've been below 20, we've gotten big market sell-offs this whole year. We got down below 20. I said, this is what I made a pretty bold prediction right at the beginning of December, that we're going to see some selling, and we got a little bit of selling, but look, it didn't even get to the fear. 30, above 30 is fearful. We're right back down to complacent, not even worried at all. And I'm telling you, that sentiment is just too. The problem with this is just I just can't see how the market can rally significantly with the VIX down this low. If the VIX was up above 30 or even closer to 30, I could see where maybe we could see a nice long market rally possibly taking place. But down here, it's just the opposite. It's screaming that we're about to get blindsided, and the train's coming. And hopefully we're the ones that are able to see it before it's too late. Maybe there'll be others out there that'll see it coming as well. But that's, again, like I said, maybe this is the one time where the market does take off and rally and the VIX goes lower. Typically, though, you don't see the VIX down around 15, 16 unless you're in a bull market. We're not in a bull market. In a bull market, you'll see the market sell-offs will push the VIX to above 20, and then it'll come back down to 15 or 16. I can show you this if you want to go back a little ways. So back in, well, I shouldn't say just to 20 here. So this is back the end of the bull market. Remember, the bull market really started beginning of January of this year. Before then, we were still in a bull market, and you can see the low part of that range is a little over 15, maybe we'll call it 16. And then you get these sell-offs that would push it up to 22, 23, 24. Remember, 30 is fear, so none of these were fearful sell-offs. And then come right back down, the market would take off again. That's what you would expect in bull market conditions. We're not in bull market conditions, and so we should be seeing with that first sell-off in December, we should have been up here at 30, and we're not. And this is probably one of the biggest parts of my argument that a big sell-off is coming, along with, Fed, knowing what the Fed needs to do. The Fed cannot take their foot off the brake, or we'll go right. The economy will take off again, which sounds good, but that means spending will continue and increase, and inflation will be stuck. And we'll get into a situation like the 70s where it takes us, 8 years to get over inflation, or however long it was, 6 years or whatever, to get over that inflation problem. I can see what the Fed's doing. They're trying to shorten that. Let's get inflation under control this year, so it's a 2-year problem. And yes, it's going to crash the economy, but then we can lower interest rates and bring it back up again. But people have got to be afraid to spend. And so anytime you see these people come on TV and say, well, I'm bullish because the consumer is not showing a fear to spend yet, or is not showing any fear to stop spending, or we're not seeing any slowdown in the spending yet, that's a bearish sign. That means that Chairman Powell is going to say, well, I got to keep going. Now, part of the problem that they are seeing is that, they're not seeing spending slow down, but they're seeing debt rise. So people are spending money they don't have. They're putting on their credit. They put a lot of money on their credit cards over the holidays. Well, if that doesn't scream as a problem, I don't know what else does. You're talking interest rates that are 4 times what they were 2 years ago on their credit cards. Their credit cards are now 30% interest on the debt they're carrying. How long is that going to last? And all that extra money they're paying on interest is money that they're not going to be able to spend anywhere else. We're going to start to see spending numbers come down pretty quick, and that maybe that's what everyone's waiting for to panic sell, but I don't see how that's not coming. Now, again, I'm not a fundamental expert. Maybe some of you are, and you can make an argument as to why I'm wrong. But the charts are backing up what I'm seeing through all this. That the actual charts are showing this decline, and I don't care. I'm always going to trust the charts over the fundamentals that I see. A lot of times the fundamental indicators are lagging anyway. They're late. I remember, by the way, and this is a side note, I remember back when the financial collapse hit. I'm not comparing this to the financial collapse by any means, but I remember that right after the big drop there in end of September, beginning of October, there was some people getting laid off, okay? But I remember somebody coming on TV and saying, I don't think it's going to be that bad. I think the worst is behind us because we're not seeing massive unemployment yet. You know, we're not seeing these big layoffs. Granted, it had only been like a couple weeks from the big sell-off there. This is like in November or something like that. Well, we haven't seen the big massive sell-offs yet. Well, what happened? December, we started to see big unemployment numbers come in, and the market kept declining all the way into March. I kind of see a similar thing here, where people are saying, "Hey, we're not seeing it yet." Well, the market is going to go ahead of it. It's going to move ahead of when we start seeing those numbers come in. The technicals always lead the fundamentals, and I don't know. This just is lining up to where we're going to see. I think we're going to see a pretty ugly sell-off here pretty soon. All right. Hold on here. Is anybody having trouble with the audio? I just had a comment here that they were hearing two voices, probably echoing a little bit in the audio. Is anyone else having that problem? If so, I can call back in, because I know that would be really disruptive if that's taking place. Can someone let me know if they're hearing it? Okay, no. I've got to know. So it could just be on that person's end. If you are hearing audio problems, just let me know. I'm going to continue. I'll keep checking. But I can dial back in pretty quickly within a couple minutes, and usually that'll take care of it if it's taking place. So, all right, everyone's saying it's good. Okay, I'm assuming it's good then. Let me know if that changes. All right, I'm not going to spend much time on these chip stocks and things. I covered that on Tuesday. I want to get into what the purpose of today's class is, which is a stock-specific area. Now, I didn't like a lot of patterns on the new buy list. I've been going to that a lot lately. And by the way, I get that this is a class where I'm supposed to come in with stock picks, but like I said, it's hard. I really feel I worry about making a recommendation or pulling up a stock because I'm afraid people start loading up on every stock I talk about. And we just got done analyzing the markets, and it's just the opposite. We want to be in cash. We really don't want to do anything. I would say just enjoy your weekend. Take the next couple of days off. Probably take the first week off next week if it starts to get ugly, or maybe trade some of those inverse ETFs. I'll mention some of those as a possible trading tool. And just keep in mind too, even if the market does rally, and I'm wrong, and the market does rally instead of drop, and I start turning more bullish again later on, we'll catch it. Okay, we'll profit from it. There's a lot of room for the market to rally from where we're at. If it just decides it's going to ignore everything and go higher, we'll be fine. I think people lose a lot of money in these conditions because they want to pick the bottom. They don't want to miss out. The fear of missing out, FOMO. And so they start to see the market move up a couple of days, and they don't want to miss it because this could be it. It could be going all the way back up, and they can see where all these stocks have been. And if I just get in right now and they go all the way back up, I'm going to make so much money, and the greed kicks in. And then that's just a rally within a downtrend. They get they get, they get their account, so they load up, and now their account gets cut in half or worse. And then when we do bottom and we start to go into a bull market and these trends start to come back up, they don't have the money to take advantage of it. So just keep that in mind. Now, I'm going to go into the sectors here. There's a couple of sectors that I still really like. I've been in and out of these during the year. Aerospace, I still like a lot of these stocks. I keep coming back to, with that war in Ukraine, all these countries that weren't buying weapons are now seeing what happened there and how quickly a company could be taken over. They're buying weapons, and these companies can't make them fast enough. And again, a lot of these they've done pretty well. They've got Lockheed Martin right here, 94 strength rank. They did have a pretty good move recently. Since then, they've kind of been consolidating. And so when I look at this, it's like, these are stocks that are willing to. Now, you might want to wait for the sell-off to happen, and that's what I would recommend, is wait until if we do get a market sell-off, these could come down and give you a better entry. But they are going to make, well, assuming that they're managed properly. You could have a lot of sales and lose money because your CEO is not very smart and mismanages things. So, but most of these CEOs of these aerospace companies are pretty smart. They know how to do it, and they should be making tons of money over the next several years. Definitely an area when the market is bottom that you want to have exposure to. Because like I said, I think that's going to last for a few years where this demand is going to be. Now, at some point, it could get to a point where people have got their supplies now. They don't need new supplies, and there's a glut. They've overproduced, and that'll happen at some point in time. We saw it with chip stocks. Remember, chip stocks there was a shortage, and then they made a whole bunch. The chip stocks did very well the last part of that bull market. And then everyone had their supplies, and they had their extra supplies in case of another shortage. And now the chip stocks are getting hammered right now because there's not a huge demand out there. That'll cycle back through again. But you can see the same thing happen with these aerospace weapons makers, things like that. So I'm not saying that they're going to go up for years and years and years, but at least in the near term they should. But look, it's kind of consolidating through here. You could even just buy a breakout, wait till it breaks out of that range. That way, if we do see a market sell off next week or in the next couple of weeks, maybe it comes down and you get a better entry point somewhere as well. But Lockheed Martin's one I like. I like almost all these. Raytheon is in that group. RTX 90 strength rank, so a little bit at the lower end range there, but I love the pattern. Again, a corrective pattern, more choppy, more sideways, impulsive, corrective, impulsive, corrective, higher highs, higher lows, acting like an uptrend. Now these are all at holds right now, at least. Well, actually, they're going back to a buy signal today. They were, so this will go into the buy section. It updates after the market closes. The reason why it does that is it could look like a buy right now, but what if it fades into the close? It would probably go back into a hold. So it waits till the end of the day to call that a new buy signal. But here again, as additional confirmation, you can just say, well, just to be safe, let's see if we can break out before I add that, or again, wait to see if we have a market sell-off. But I like Raytheon. I do like General Dynamics too, which is right below Raytheon. It's a 90 strength rank as well. Again, all these have been consolidating. And then the one I have traded a few times is actually under the buy section here, under the buys, which is a Northrop Grumman 95 strength rank. Now, this had a little bit of a volatile move. We caught this move up through here, got stopped out on this little big drop right here. Now it's come back up, and you got not quite a cup with handle. This is a V-shaped cup, but with a handle. But you can see if it breaks out. If it breaks out, you can take the top of the range to the bottom of the range and project that upward. You can see there's huge potential there if it breaks out. But it's probably going to need the market to rally as well. And so that's what I'm saying. These are, if you get a big market sell-off, these would be ones that have a lot of upside potential to look to get into. I get a question a lot on why do I look under the holds when I'm doing some of these sector analysis? Well, this will make a lot more sense. We're in a bull market because it's one of the easiest trades to find, easiest ways to find new trades is what we're looking for is a nice chart. And obviously we're looking under the hold section. So the final confirmation to get in the trade is just to wait for it to go to a buy signal. So for instance, let's see if General Dynamics. So General Dynamics is at a hold right now. So if I like the pattern, like I do, and we're in a bull market condition, what I can do now is, so now I'm looking for it to go from hold to buy. I could watch it every day, or you could add an alert. I could put this in my watch list. Okay, so we'd add it to a watch list. I haven't used my watch list for a while. I have the stock specific class here, but these are old stocks. I need to go through and just completely wipe out that watch list. But you put it in your watch list, and then you can come over here to the right side and set up an alert. I could set up an alert to tell me. Here's General Dynamics right here. Tell me when the signal goes from hold to buy, and it'll send me an email when it switches. So I can find a bunch of these patterns ahead of time, and then I'll wait for the email, and then I get the email. I could reevaluate it, see if I want to still get in. It's a real nice process there to go that way. And another reason too is that I like to look at the hold section is sometimes when you're looking under the buy section. See if I can find one here that's maybe. Yeah, so this is under the buy section, but it's already in its move. There's an impulsive move right there. Could that keep going higher? Yes, but probably getting into the extreme reversal risk. Yeah, you're in the extreme reversal risk range. You're probably getting close to going into a correction of some sort. I don't want to be buying in right when it goes into a correction. I got to wait for it to be done correcting. So that's a little bit of why I do it that way. I do look under the buys a lot of times if I have extra time, because sometimes you find stocks that are just barely went to a buy signal and have a great bullish pattern. But like I said, if you're looking for real simple, that's a great approach, is just to go into the holds and then find a nice pattern, and then you wait for it to go from hold to buy. Question, IWM, did it not do a double bottom? I think that was in a corrective pattern, if I'm not mistaken. I hate to go back and reanalyze what I just analyzed here, but I did get a question. You could call that a double bottom, but remember it's a corrective move. Remember the correction, the previous move was down. Whenever you see stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. A true double bottom would be one that where it went up a ways and then came back down. That would be more of a bullish type of double bottom. This is a consolidation right through here. This is actually a correction of this move down, more likely to keep going lower. By the way, there's a lot of trading videos there on, if you go to the education tab under TradersPro, there's a lot of videos there. If you go into the YouTube channel and subscribe to TradersPro, there's access to a lot of content there. I I get into all kinds of different. I teach you about chart patterns, candlestick formations, ABC patterns, basic trend analysis, stair-step analysis, things like that. And there's a lot of content there that you can learn. And again, if you can learn all that, it really makes your job easy trying to read these trends and read what I'm telling you. Now, I also teach it in these live classes as well, but they're taught in a lot more detail in those training videos. All right. Another sector I like is basic materials. This Olympic Steel, Zeus, ZEUS, 95 strength rank. Now again, it could, this could be the ABC pattern right here. It kind of pull back to this breakout area. I don't like the movement up here as much. I'd want that to be a little bit more impulsive looking, where it's a little bit more sideways looking. Makes me wonder if it still has another move down. It's just kind of what we call a double correction. Let me see what the signal is on that. Still a hold signal right there. But the overall pattern still looks pretty good. It's pulled back a pretty decent amount. Again, I'd like to see how it looks after the market sells off. The CMC commercial metals, again, it's kind of again moving a little bit sideways here. Had a nice little steady uptrend. That one looks pretty good. And then I know I like the gold stock. So if you drop down a little bit here, there's Royal Gold. It's an 87 strength rank, so we're getting down a little bit lower on the strength rank scale there. I think just about any gold stock should perform pretty well over the next several months. That's looking like it's coming out of a ABC correction right here. It could be getting ready to break out. And then there's a few other gold stocks that are under the buy. Well, if you go to basic materials, you click this little plus sign right here. It shows you the breakdown of several different types of material stocks. Specifically, I'm looking at gold mining stocks. If you look under the buy section here, there's 19 that have buy signals right now. These AGI and AUI, Yamana I'm more familiar with. But again, that chart looks good. It already has a buy signal, but that looks like it's acting like it wants to go higher. And then same with that AGI right here, Alamos Gold. So that's probably all I would consider right now, but that gives you at least some stocks to maybe put in a watch list, keep an eye on. Let's take a real quick look at the S&P before I sign off. Yeah, we're still near the highs of the day. See how that looks going into the close. See if it fades at all going into the close. If not, though, again, I think it could rally. It still looks like it could rally a little bit further tomorrow, but the big question is going to be next week. And so our next class is going to be on Tuesday. Remember, the markets closed on Monday for New Year's. I know New Year's is Sunday, but the observation holiday is going to be on Monday. Same schedule like this week. So the first trading day of January will be the day we have our market update class. It should be interesting. Who knows, though? It could be nothing to talk about, or maybe it's a rally day and it's what we're analyzing to see whether it's throwing us off a little bit or setting us up for the decline. But I think next week could be a pretty interesting week and have a lot to talk about. So we'll see what happens. Have a great New Year's, everyone. Be safe. Have fun, and we'll see you back here next Tuesday for the next market update. Bye now.